8, 7, 6, 5, 3, 2. Booster after chamber pressure is nominal.
Particularly 33 seconds into the test flight of the inaugural Starship vehicle, tower clear to land a pitch over. Propulsion reports first stage engines nominal. What a sight from the ground cameras at Starbase. We're flying at twice the thrust of the Saturn V heading to space.
Acquisition signal, Corpus Christi.
We're throttled down and throttled back up. Going through the period of maximum aerodynamic pressure. As the velocity increases, the density of the atmosphere is decreasing.
Max Q.
Lessening stress on the vehicle. The call out, Max Q now. Continuing to watch the first stage as we head down range. "100 seconds into flight. Our next major activity is going to be shutdown of the first stage. The Houston tracking station now acquiring the vehicle. With shutdown, we will get separation of Starship and Super Heavy and ignition of the Starship engines. When Starship separates, we light up 6 engines in a staggered sequence. If all goes well, those 6 engines will burn for almost 6.5 minutes. Onboard view from Starship. And there's views of the Raptor engines on the second stage as we prepare for stage separation. Now, after stage separation, the first stage will flip and begin a boost back maneuver for landing in the Gulf. Continuing to fly, 2 minutes 40 seconds. Let's get ready for main engine cutoff.
Booster engine cutoff.
Beginning to flip for stage separation.
Trying.
As of right now, we are awaiting stage separation, where Starship should separate from the Super Heavy booster.
Yeah, Kate, right now it looks like we saw the start of the flip, but obviously we're seeing from the ground cameras the entire Starship stack continuing to rotate. We should have had separation by now. Obviously, this is does not appear to be a nominal situation.
Yeah, it does appear to be spinning, but I do want to remind everyone that everything after clearing the tower was icing on the cake. And there, as you saw, as we promised, an exciting end to the Starship inaugural integrated test flight.
So I thought that was pretty awesome. And there was an article this week by a gentleman named Robbie Terbalusi, who is a CFA, about the singularity, the concept about how technology becomes so pervasive and so powerful that it changes everything. And I'm a believer in the smart everything sustainable world. You've heard me talk about that 100 times at least by now. And this launch by SpaceX was, I think, the first step of not only going to Mars, but getting to the asteroid belt and potentially even further than the asteroid belt. I think that we will probably see manned spaceflight to Mars in my lifetime. We might see manned spaceflight to the asteroid belt, which would, and you need to really understand this, it would alleviate virtually every metals, minerals, and natural resources problem that we have or could have, probably set the stage for manned space colonies, or at least research stations, maybe by the end of this century. As you all know, in 2061, Halley's Comet comes back, which is cool. I have decided to live at least that long because I want to see it. I missed it last time. But in 2062, according to the prime timeline of Star Trek, that is when we make first contact with the aliens, which I have mentioned now just a couple times, especially in the last webinar or two. Why is the Pentagon talking about maybe there's a mothership out there doing space exploration? I don't know. Makes you wonder if they're getting us ready for something. More importantly, as an investor, we should think about how fast all these things are moving. Are they accelerating? Are they in a straight line? I think it's clear that the pace of technology has been accelerating for a long time, especially since the advent of the internet, because that allowed research and development to be shared all over the world, from the academic level all the way up to the corporate level and the government levels and the institutional levels. And what we are experiencing right now is a transition period that 98, 99% of the population completely struggles with. Now, I showed you an interview beforehand. Elon Musk was having a talk with some of his staff, and it looked like it was a recording from yesterday about the launch that was coming up. And it was pretty interesting. So if you get a chance, go to the SpaceX YouTube channel and just watch some of the interviews, the live updates. Now, this particular YouTube channel is called NASA Spaceflight. And I watched on this channel, and I'll tell you, these guys are scientists or something. And I'm paying the $1.99 for this now per month because A, it was entertaining, but B, I think that keeping an eye on the space economy, developments in the science, the transferability to all the other technology back and forth that we have going, the large fourth industrial revolution, the clean energy transition, all these things are connected. It is where the next fortunes are going to be made, and you can decide if you want to take part in that. Over at my Blue Mound Asset Management website, I talk about what I do. I offer sustainable growth investing, retirement income, then inheritance investing. If you are investing for the future for yourself or for people who will inherit your money, you need to have a sleeve in your portfolio for some of these so-called moonshots. And I don't think that this could be described as anything other than a moonshot. So we're going to talk about a couple things today that I thought would be important to our long-term discussion. So if you get a chance, take a look at this website, NASA Spaceflight. Just a little aside, I decided to go on their website and I found a t-shirt that I will be wearing at the World Series of Poker. I think that you can understand why I would wear that at the poker table. I think it'll make people laugh. And I think the whole full stack thing, given that I am going to be trying to take people's chips, is kind of funny. In any case, back to the singularity. I will be interviewing Rami for Seeking Alpha in the next couple of weeks, shooting for the 28th, and then that should be released the following Monday. And we will talk about a lot of ideas, in particular, one particular stock, Tesla, as well as some other concepts that were thrown around the chat room yesterday and today, because I posted this article. And one of the conclusions that Rami has is that there will end up being a lot less labor getting done because everybody is going to be out of work because of the AI. And I know that's a fear. And at least for the next 20 or 30 years, it's probably completely wrong. There's not going to be a shortage of jobs in the next generation or two. Jobs will switch, they will change. What we know is that aging demographics is pulling millions and millions of people a year out of the labor force because they retire. The French are so eager to retire that even though it'll bankrupt them if they don't make some changes to their pension and retirement system, they don't want to work until 64. Their retirement age is 62. By comparison, in the United States, people entering the workforce now, retirement age is at least 67. I know mine is 67 for full Social Security. I would anticipate working until somewhere between 70 and 75 on basically a full-time basis, although full-time might switch from 60 to 50 to 40 to 35 to 30 hours over that time period. Certainly is the goal to get down to 30-something hour work weeks. And I think that is the future. Why do I think there's not going to be mass unemployment? It goes back to that aging demographics. There are 10,000 baby boomers retiring per day in the United States, give or take. Over the next decade, 75 million baby boomers will retire. Half that many will enter the workforce. We're already short pushing 10 million people to take jobs. Now, there are parts of the world where they'll have some problems, but just like a lot of the emerging markets skipped over the whole shopping mall era, went straight to Amazon-like buying, building up supply chains and logistics chains as we speak so that they can kind of skip the 1980s. And that's a shame because they had pretty good music. They're going to move right into a 30-something hour work week, like from day one as they build their middle classes. United States, Europe, some other places will come down from 50, 45, 40, 35 into the 30s. The French, again, are way ahead on that. They value their free time quite a bit. So we'll see how all these things develop, but at least for a couple more generations, until the demographics curves balance out, you're not going to see the apocalyptic versions. And by the time the AI and the robots and the machines are doing everything, we'll be so far into space travel that you will literally have huge numbers of kids just going straight into engineering and technology at a level that being AI assisted is they will all end up being like the cadets in Star Trek. That's where we're headed. We're not headed to some dystopian future. We are headed to a future, and again, it's generations out, where work is required, but it's not the back-breaking type of work that we had to do when we built the highway system and the high rises. Things will be more engineering in nature, how to work with the machines, how to use the machines to build that big thing a lot easier without people falling off of scaffolding, without people losing hands, without people getting so physically beat up that they die young. You're going to see life expectancy clear 100. It's paused because of COVID and because of a drug epidemic in this country that we are unwilling to fix for whatever stupid reason, probably somebody's finances, but that's what's coming. And if you have a dystopian, unhopeful view of what's coming, not only is it detrimental to your own health, mental and physical, because the stress will wear you out, you're just wrong to be doing it. You are going to see the world get a lot better for a very long time. So what should we be thinking about? Let's just think about the stock market. I wrote an article this week about let the zombie hunting begin. Very short bullet point. Fed's COVID-19 pandemic response, and the federal government as well, delayed the inevitable decline of well over 100 zombie companies hiding in the SP 500. In the Russell 1000, an outfit called New Constructs, which does institutional level research and uses AIs to really break down a lot of things, similar to what I've been doing with Centio, except they package it different. Another $12,000 a year thing. They think there's over 300, about a third of the Russell 1000 that are zombie companies. I was saying 20 to 30% of the S&P 500. So we're pretty much on par with each other. So here we are, and we have a wall of commercial debt coming due that was financed at low interest rates and high asset prices. Now the interest rates have gone up, asset prices have come down because COVID shifted the way the world works. So there's huge problems with commercial real estate. That means that the banks will have to tighten up on credit just a little bit, and that's going to make it harder for capital-intensive businesses to maintain their margins at a minimum. And that's going to cause a lot of stocks to chop along sideways, take a step down, and then chop along sideways again. So just like we had this step up, a lot of companies are going to have a step down, and they're not going to get off that step because that's probably where their share prices belong. And I started covering some of those. I'm going to, as we go into and come out of earnings, just to have a theme for a few months, maybe through the next earnings, I'll talk about zombie companies. If I can whip out 20 or 30 articles about companies that I think just aren't going to do that well, I will, because, people like to go into the comments and say that I'm nuts, crazy, stupid, whatever. However, for those of you who've been around a while, I would put those bottom fishing prices on my stock charts. And people would be like, that's so far away. And you've been seeing over the last year, stocks coming down 30, 40, 50, 60, 70%. And suddenly they're starting to get to those bottom fishing prices. If it's on my list, as you get close to the bottom fishing, you should be thinking, do I want to buy this? Not should I sell it? If it's not on my list, you may want to think about why the hell did I ever own this in the first place and cut your losses. But that's a stock to stock thing. You have to know the company. And certainly my list is not complete with potential good companies, and I'm not right about all the companies that are potential zombies. And while I've been trying to get you to focus in the last year on buying some of these beat up small caps in particular, knowing that I was going to have to try to keep you from getting impatient, now I'm telling you some of the large caps and mid caps are starting to look attractive. And this will be more attractive to you and more comfortable for you to buy because, hey, I know the name. But hopefully you have started to learn the stories of these small caps. You've read their presentations. You started to learn about what they do and why they are so integral to this fourth industrial revolution that encompasses the massive change to the energy systems that are ongoing and accelerating, and this nascent phase of the next era of space travel. So while we got to the moon in the 1960s, 1970s, and now it's been, is it almost exactly 50 years since the last time we were on the moon, or was it 45 years? It's something like that. I forget the last time we were to the moon. I know it was in the 70s. Think about that, and then think about some of these small cap companies. When you hear the shorts going, well, this company's been around 10 years and they haven't made a profit yet. Well, shit. We haven't been to the moon in 45 or 50 years, and now we're about to do it again. It takes time to do things. That's all there is to it. We finally got to the point where we have AI that can do calculations and write software so fast and so well that now we can move from the calculation to the implementation, which is what Musk is doing in a couple of different places: space, EVs, AI, other engineering for industry, the Boring Company. So while he's like a farmer and likes to spread his seed, I will tell you, it's not just babies that he's making. He's building companies that will change the world, whether these companies end up being the leaders or a competition comes and they take over. So with Tesla, I had Shooter whip out a chart. I've been telling you for a while, since it was way higher, that Tesla could get down to around $150. Could even go make a run at 100. And it had already done that. And maybe we should have bought it at 120-ish. But this pullback that we're getting now looks like it will fill a gap and get down to around 146. I am putting my first buy orders in at 148. And depending on what the momentum to the downside looks like when we get close to that, I may lower that price. Or I might just make it a market order if it looks like the downward momentum ends. We are at the nitty-gritty phase for wanting to buy Tesla. I mentioned it the other day. So I'm trying to get you ready for this, because if we can buy Tesla shares at a fair market cap valuation that discounts the future because people are pessimistic and dystopian and scared and ideological, and their heads get warped because of the elections coming up, and they decide to just hand us these shares, I'm going to take them. So I'm going to keep you up to date on this, because Tesla is going to be a $1 trillion company again. And I think, because of all the things they're going to attach to the cars, the fact that they have an insurance company that could be massive, nobody talks about that. I've mentioned it every time. Think about the biggest buildings in your city. How many of them are insurance buildings? If Tesla ends up being one of the 5, 6, 7 biggest insurance companies, take a look at the market cap of Prudential or Allstate or whoever, then dump that on top too. And think about Google, Microsoft fighting it out in AI. Musk threw down the gauntlet the other day. I'm coming for him. If you don't believe that Musk targeting something that you're working on is a big deal, then you don't run your business very well. We need to start doing the reading on Tesla, because it's getting close to the buy price. All these concepts have to do with the global trends ETFs I've put together for you. I have updated the very short list, and I will be adding charts soon. Some of them are going to be links, but via an article to Shooter's charts, which he's been updating a couple times a month on the ETFs. And we would need, not in the core holdings here, but in the tactical trading part, we need to keep an eye on this, right? Where do we want to be? I'll probably just take this fintech fund out of here and leave it at the Next Gen Internet. They're basically the same fund, except that the Next Gen Internet has access to some Bitcoin. We've talked about Bitcoin quite a bit lately, since, let's say, late last summer. I've been making the argument that Bitcoin is the hedge to the dollar getting too strong. So while Japan and some other countries are reducing their reserve holdings of the dollar, I need you to understand something, and we haven't paid a lot of attention to it. There are two different ways to think about the dollar internationally. One is as a reserve currency. How much of it do other nations just hold on to? Two, for transactions. So the money that's held in the central banks of other countries is just held, not necessarily used for transaction. I put up a chart the other day that showed over 70% of all the currency transactions in the world involve the dollar. Dollar for another currency, another currency for a dollar. So of all the currencies in the world, almost 3/4, I think it was 74%, down from 78% 20 years ago. Not a real fast attrition rate. 3/4 of all the currency transactions on the planet involve the dollar. And that is because of how many companies and countries transact in the dollar. They transact in the dollar because compared to other currencies, it's that strong. We deficit spend to hold the dollar down. I'm telling you, that's why we do it. While oil was important to the dollar with the petrodollar deal with Saudi Arabia, we don't need it anymore because the dollar is everywhere now. Petrodollar helped the dollar permeate the entire global financial system. And it's going to be difficult to unentrench the dollar in the next few generations. And if it is disentrenched, is that the word? Unentrenched, disentrenched? I think it's probably dis. It'll have something to do with this smart everything sustainable world, making money just less important. Think that through. I wrote a paper in about 1993. I think it was, I went to a summer school that year because there were a couple traveling professors in economics, one from Israel. I forget where the other guy was from, somewhere in Europe. And I wanted to take those classes. So I took 2 summer classes. Discovered that if you are a young man in the summer, a university student, you should probably take a couple summer school classes because the girls will outnumber you about 5-1. In any case, I got married about a year later, so I didn't get to do that again. This is just a message to the young people listening, standing behind their parents or grandparents. I mean, what the heck is you? What are you listening to? Go to summer school. You'll like it. In any case, I wrote a paper, and it was something along the lines of The End of Economics was the title. And I wrote this paper, and I basically said that at some point, technology, very Star Trek even back then, would create so much excess in the economy that we could all pretty much do what we wanted, and that money would become less important because it was very easy to get almost anything you wanted. So be some choices, some limits, but that poverty would eventually be almost wiped out. Always be some poverty because we're imperfect, but mainly wipe it out. And I believe this. Again, I don't know how long it'll take. It'll take generations. Between now and then, we are going to see a massive build of wealth in this country, in the United States in particular, because the dollar is going to stay strong, and that's going to shock people again. Just like 10 years ago, I said the dollar would be strong and have a bull market. I'll stick with that. The new millennial dollar is going to remain in a higher trading range for a very long time. DXY probably have a narrow 10 to 12% band on each side of this millennial dollar that I've shown you before. Somebody asked, what do I think about Ray Dalio's prediction that the dollar and the U.S. will be displaced by China in his book, The New World Order? I think Ray Dalio has been wrong about so many things in the last 10 to 15 years that largely led to his retirement. Just like I said a year and a half ago, 2 years ago, that Elon Musk would lose half of his wealth for a while, and it's happened. So will Ray Dalio, because he looks at the world through the prism of the past, and he struggles with looking at the future. Unless China completely changes their political system, has a a revolution of some sort, hopefully bloodless, nobody will ever trust the Chinese currency. And I would bet on India way more than I would bet on China. And if Russia ever threw out their government and moved into a more democratic republic type of system, they might even be more important. We'll see. This idea that the dollar will be displaced under the current political regimes is nonsensical. If you are somebody on this planet and you want your money to be safe, you want to be able to transact, you want to have some store of value, do you want to be trusting an authoritarian government or one that edges towards libertarianism once in a while? Hands off, hands on. I don't think it's a hard question to answer. Let's ask it this way. How many of you would exchange your dollars right now for the Chinese yuan? I don't think anybody raised their hands. Can't trust them. The currency becomes a trust issue. Now, I do think Bitcoin is going to get a lot more expensive and a lot stronger as it gets adopted by our enemies, our frenemies, the emerging markets, and the wealthy. And all of these things are going on. I told you in November and December to buy Bitcoin. Most of you didn't listen because you don't understand it yet or don't believe it, or you're looking backwards because it's familiar rather than forwards because it's different. But Bitcoin is the dollar hedge. And it's not a hedge against the dollar getting too weak. It is, but it's mostly a hedge against the dollar getting too strong because as 75 million baby boomers retire the next decade, think about how efficient our economy has to become on the back of all the resources we already have, the technology that's making certain resources less scarce, right? Rare earth metals, not going to be as tight of a market as we thought. Lithium, not going to be as tight of a market as we thought. Steel, not going to be as tight. Technology is making things easier. The new production process at Tesla, which they think is going to lower the cost of building cars by 30 to 50%, because it's really just a redesign of the assembly line with component-based cars, plug and play, is amazing. I was watching the video yesterday. Again, I showed it when it first came out, then I reread it yesterday after reading somebody's article. Cars are going to move from an assembly line to basically the car gets rolled down and people keep going in and out of the car, being 4 or 5 pieces that just get snapped onto the frame. And the frame already is going to have the spots where you sit. So imagine the interior of a car dropped onto the frame of the car and then the outside of the car built around it. Much easier than going in and out and in and out and rolling the car down the assembly line. Remember, the original assembly line, they attached a car frame to a rope. They pulled it station to station. That was the original assembly line by Ford. The new assembly line that they're designing at Tesla is a lot more like those 3D holographic images that you see in movies, where somebody just waves their hands around in the air and everything snaps together. They're using robot arms, and I'm imagining probably the parts lined up in bins alongside to build these cars. They're experimenting on it now, how best to do it. Will it be 2 pieces of the car snapped together on the top, side to side, or front to back? Will it be just one unibody dropped on top when they're ready? There you go. You build it from the frame up and drop the rest of the car on top and snap in your glass roof. That probably will have solar cells built into it now because of the nanotechnology that collects solar energy. Pump it right into your battery in your car. So these funds have these ideas in mind. For those of you who are afraid of the single stock risk, and that's okay to be. If you build a good basket, you'll beat the S&P 500 handily. Now, I do think that the S&P 500 return will start operating at lower valuations because only parts of it will have valuation expansion. And these ETFs will help you get into the parts of the market that can carry a 15 or 20 or 25 PE versus the parts of the market that can only carry a 5 or 10 PE. A lot of the oil companies are between 5 and 10 PE. Why is that? It's a pretty easy answer. There's no growth. We know that oil demand is peaking right now, sometime in the next 2 to 3 years. It's that imminent. I still think it'll be 2025, 26 right there. And by the end of the decade, oil demand falls. And that's why the price to earnings ratio on the oil stocks aren't that high. When you look at an oil company, you have to do a mathematical calculation about, okay, what is the run out period? How long before their product is no longer needed? And how much can they collect in profits during that time frame, which will be an arc. It starts pretty level, but eventually turns down a little, and then eventually falls off a cliff. It's probably a 15-year period. maybe 20 for a lot of those companies. The Permian companies will be the last ones to fall off the cliff. And, Saudi Arabia, OPEC countries too, in the Middle East, because they really do have the cheapest oil. So S&P 500, I mentioned the June low from last year. And somebody said, don't you mean the October low? No, the June low right here is what the stock market has to hold to avoid breaking to a new low. And really, it's right about here where the 50-day turns up. If this turns down, it needs to hold the 50-day. It needs to hold right around 380 on the S&P 500, or that probably leads to some waterfalls. We'll see which way it goes. Now, Shooter did a video, and I'm going to let you watch it for the next 15 minutes, and then we'll do a couple of questions. But I think this is very important. This is part of the $1.99 pay channel. I just opened a discussion with Shooter about maybe we do a 20 to 30 minute video every afternoon, or Monday through Thursday anyway. Fridays if there's volatility. We'll see. Him and I have to talk about it, because that last hour of the trading day is pretty important. So I think maybe an hour before the close, we'll do about a 20-minute presentation, mainly him. I'll ask questions to help frame things for you, and we'll go through his charts. But this video is one of the best ones he's done, and I want you to understand that you need to be a member. It's pretty easy to become a member. It's only $1.99 a month. It all goes to him. I'm trying to figure out how to give you cute little emojis. Right now we have some Star Wars stuff. But you can see this is a lot of stuff that you have to be a member to get. So if I can convince him to do a video every afternoon, I think that's what we're aiming for. But even if it sticks with 1 or 2 a week, it's pretty good stuff. Let me prove it.
Well, good afternoon, folks. It is Shooter. Sometimes I just get these feelings with a tape like something's wrong, And let me tell you, my spidey senses are just tingling right now. I can't tell you exactly why. It's just not acting right. But at the end of this presentation, please review our disclosures. Okay, let's try and do this justice. Well, I have this thesis. For those of you that have listened to my rants, when I get a hold of something, I'm trying to figure out how to trade it. And, the yen carry trade, I think, is at risk here. One of the larger money managers in Japan has announced they're going to wind down their foreign currency holdings, which includes about $63 billion in U.S. treasuries, bonds, etc. Anytime something's going on in Japan, it catches my attention. My thesis is that, are we going to have another drawdown related to a financial crisis that originates either in China or Japan? I have no confirmation that such a crisis manifests, but the yen has always been a fantastic proxy for equities in the past. Right now, I'm thinking that Venex Semiconductors, XLK, XLY, and the NASDAQ 100 will be the most likely to come off. And now I've drilled down into my work between RSI, Elliott Wave, and pattern recognition. And I know it's a complicated mess to look at in a real quick picture, but really to give you my view here. So I'm going to go from a daily, weekly to a monthly chart on each of these 4 charts. And there are going to be signs or tells that I think we should look for between these 4 instruments, which will determine whether or not we're turning. First of all, on the daily, SMH is currently diverging. So we have a confirmed high and a divergent high. So it's a second drive. The MACD also confirms the move and is showing a second divergent high there. So it supports that as far as the count. And if we go and step back in time, this is where we've had a confirmed low and a divergent. Confirmed low, divergent low, confirmed high, divergent high, confirmed high, divergent high, et cetera, et cetera. So at this point, the count suggests that we're going to break down in an ABC to the downside, in quite a large cycle wave trend channel to the downside. Now,
I'm going to pause here and just jump in. A couple reasons that's important. Not just because we've talked about it in the last couple of weeks, and that's what it looks like to me could be developing. He's saying it is developing. Second, semiconductors have been the leaders on the upside and the downside for a while, like years. If the semiconductors break down, that is generally indicative of a slowdown in the economy because they are so tied to the rest of the economy. So if semiconductors break down, probably everything else goes with it.
Which supports a drawdown. Now, if I come out to our weekly, this is where we have our confirmed high, divergence high. So this is also a 2 drive on the weekly. We've also had a primary wave setup that occurred at the top that gave us a weekly trigger. We've also just gotten a second one on the back test. So this is a larger ABC pattern to the downside. And we've just gotten a daily trigger on that. And MACD is confirming that. Here again, confirmed low, divergent low, confirmed high, divergent high, confirmed high, divergent high. Now, jumping out to the monthly. Now, I don't see any crazy patterns. My conviction here on the monthly is an ABC pattern to the downside. At this point, divergence off our B is lacking. In other words, it hasn't manifested yet. All right, let's jump over to XLK on the daily. Same kind of look. Now, we have a confirmed high and a divergent high here, and MACD supports a turn lower. However, our count suggests that we're going to still push higher. So this is where the multiple of technical indicators I looked at sometimes are conflicting, but we still have a view. So XLK is a tell for me. If we come off, if we close below this 146.51, hello, that's weakness in the market, because now this count is breaking and it would indicate that we're probably going to turn to the downside. So that's one of the tells that I want to point out. Now, jumping up and look at the weekly on the XLK, select tech spider, here again, it looks to me like we put in a confirmed high here. So we have one more divergent high up around our 3, around 157, and then we could turn south for a breakdown. Now, even though we're in this cycle wave, there's nothing that would prohibit this from expanding into an ending diagonal and giving us a decent drawdown back to the 50-day or the 200. Now, right now, RSI, it really isn't confirmed because we don't have the second count, and the MACD is not supporting a turn down yet because we really haven't put in our higher range around 5 here in the MACD. So let's jump over to the monthly. I don't see anything different on the monthly as far as XLK. Start off with the daily. Now, here again, this is a weaker count if we look at what we have here. So we have a confirmed high, divergent high, confirmed high, divergent high. And right now we have a confirmed high, but no divergence here. No divergence. So we could come in and still put one more high. However, I'm getting a primary wave set up based on here because I have a primary wave and 1 wave degree below it that is reflecting to the downside. So now I have a count without confirmation with RSI, but the MACD is confirming the downtrend. So we had, basically we had a higher high, lower high, lower high, and MACD is supporting that with how it's breaking down. There's sort of a trend line down there. I didn't really draw it in there, but throw it in there so you can see it. I mean, it's clearly showing some divergence. I wouldn't say that it's glaring, but it's there. So just giving you a visual there. So, it's declining, which indicates we're in a downtrend. So, our ultimate target, and I realize that's a 5-wave down. So if we jump out to the weekly and look at this, we have a confirmed low and a divergent low. So maybe we put in that third drive here. That's, actually kind of likely. And, right now I'm showing the 149.63 right about where we are, which is showing to the downside. So now 2 out of the 4 symbols, SMH, XLK, or XLY, are reflecting immediate downside. Now, in this scenario, we do not have the MACD confirming to the downside, but clearly we have some divergence to the downside as far as the trend. Now, let's jump over to the monthly. Now, this is kind of an exciting look. I like seeing these on the larger time frame. Now, this is my own area of study within RSI, within wave patterns, with 3 drives and XABC patterns, which basically are 2 drives. Now, quite often what you get are these mounds, and sometimes they differ. And very often do they have a confirmed high and a divergent high. So we got a confirmed high, divergent high here, confirmed high, divergent high here, confirmed high, divergent high here. But because it has an overall slope, now if I could come in here and actually draw a line, I call this what I call one of my 3 mounts. And the reason, that's my own work, my own insanity, as I call it, my own design, because I recognized it as a pattern. Now, what we also have here is a view. Let me just bring in what our 3 drive would look like here, because basically we have a 3 drive pattern potentially with 100% retrace of the move that we have in XLY. So now that, that supports the downside to me. Now let's jump over to the NASDAQ and break down these different counts here as well. Now, one thing that I like to point out, when we are trending, sometimes we have a 2 drive, down here where you have a confirmed low. So this is our low. Okay, right? And we don't have anything in this entire time from 2020 through November 21 until we get this divergent high. We get a confirmed high and a divergent high here. And then we just keep breaking down, and that stair step starts to have clear tops. We have clear signal. Now, it's also reflecting a similar count to SMH, where it, is showing a confirmed high and a divergent high, but yet the count, the AI I use to do my scans for Elliott Wave, is not supporting a top yet. It's saying that, hey, we may put in the 3 and it may be an overshoot. Now realize anytime you have a 3 drive, 1, 2, 3, the third drive can always be an overshoot, and it doesn't negate the pattern. Now, jumping into the weekly here. Now, the ironic thing is very similar look to XLY. However, we have 2 different three drive patterns on 2 different time frames. So whenever you see those repetitions in time frames, it just supports the downside. However, on the weekly, we really don't have a breakdown here. We're showing a count maybe up to about 143,575. I just didn't label that because I didn't want to get off base on the count. I wanted to focus on the daily triggers where we are. But the weekly, what we have here is also a 3 drive. And let me bring the first one out. Hopefully I've done this correctly. Okay, there, we got it. The first one. Sometimes it's a little difficult. Now notice how broad this is. So we go way back to our confirmed low in January of 2009 for this 3 drive. Then we don't build in and start doing our confirmed high and divergent high, confirmed high and divergent high. Here again, my 3 mound concept to the downside, just in a very aggressive downside look. So along with XLY and SMH, as far as a downside view that might be a little more aggressive, I think we can break down here, because when I look at the daily, if we close below this 12833.31 on the NASDAQ, it opens up a breakdown of this count up here for me. So, looking at that and this 3 drive pattern. Now let's jump to the monthly so we can look at this as well. And again, let me just review RSI here. So we had our confirmed high, divergent high, and that continued even broader than the initial count. Our confirmed high, our divergent high, confirmed high, divergent high. Now, we did get a confirmed low and a divergent low for a bottom here. So that would also support 50% back on the NASDAQ, to me, as far as I look. So I think we get any kind of failure, it'll be around 1435 range. But I don't know that we get that. I'm right now we have an awful lot of oomph going into the NASDAQ for many different reasons. However, MACD supports the upside, does not confirm to the downside on the weekly here. So whereas the MACD confirmed to the upside, faded to the downside, it actually really supported the divergence if you compare that with RSI. Now jumping to the monthly, very similar look, the 3 mound view that we have here. And prior to this, we had a lot of confirmations in RSI, but no divergence here, which, typically is respective of continuation. We're looking for that when we don't have that or don't see that divergence. We're looking for a reason why it should fail, and we don't see it when you use a 3 drive.
I'm going to jump in here again. Now, in the Armageddon zombie apocalypse scenario, you can see 2018 low, the 2020 low from COVID, basically points at this area right here around 6,000 on NASDAQ. So in a horrible, horrible situation, I mean, we really could see a price down here around 6,000 or in the 6,000s. And if we do, that's not when to panic. That is when to beg, borrow, and steal every nickel, dime, and quarter you can and start getting it like massively invested, as this is when you take leverage on the comeback. So if we do set a lower than 2020, here you go, right here, down towards that 2018 level or lower, right? Here's what was resistance becomes support. So we get down to 6,000-ish, a little lower, a little higher. Do not be a seller down there.
Structure or an XABC pattern, which basically is a 2 drive. So instead of getting the 3rd drive, we only get 2. Quite often, like here, we've got 2 drives and then it broke down. 2 drives and it broke down. 2 drives and it broke down. But yet, the 2 drives are within a 3 drive in the larger structure. So let's bring in the view of the 3 drive on the monthly as far as a look here. Very aggressive drawdown. I mean, it basically takes, I just can't imagine what is going to occur for that to happen in the NASDAQ. Actually, it's a very scary look here. But right now the stop, and I'm not trying to panic anyone. It's just what I'm saying is, if we're going to look at our charts to tell us what's going on here, we should be looking for a failure of a close below 12,883.31 for a breakdown in the markets from the NASDAQ. Looking at the XLY, we're already in a breakdown. So we should look for continuation there. So we should have continued weakness in consumer discretionary, obviously because inflation is hitting everybody and pushing down discretionary spending. So looking at XLK, here again, a close below the 146.51 is indication we're going to break down. So we can take these four instruments. So we should have continued weakness in semiconductors. However, we find more strength, it tends to support the upside that we see in the NASDAQ or the upside that we see in the select tech spider XLK. So, looking at those four, and spend a lot of time thinking about how we could structure something that would give us a signal, if we're going to break down or not. So, what I've done is I've laid these charts out to try and help you a little bit. I will take the weekly, the daily, and the weeklies. I won't post the monthlies, though, in the room, only just to save time. But I will make a copy of those for you, post it in the room. That's what I have, folks. Great trading. Until next time.
All right. So I hope that was helpful to you. I will get some of those posted in an article with kind of my fundamental thoughts on it. If you've been really paying attention to the last several calls, you know that I've been thinking that we could see this breakdown going into and coming out of the Fed meeting. A lot will depend on what they say at the Fed meeting, but I think that Powell should be coached up enough to allow for more price discovery in the markets. And I think that he knows he has the cover of the employment markets, because you're only going to see unemployment tick up maybe a percentage point, but probably not much more than that. And, we've got the presidential cycle just starting. So I think that this could be the beginning of the end of the bear market, and that will allow us to position a lot more aggressively than we have been, right? A lot of us are still carrying 20, 30, 40% cash. Now, while that was an awesome hold last year to hold all that cash, we're to the point now where there's not a lot of return on the cash, even with higher interest rates. And we need to find a way of generating long-term capital appreciation and higher income generation on our cash. So look to get that converted from cash to better holdings. And if you own things that are going to be second or third best coming out of this bear market, upgrade that part of your portfolio. Don't even sell. Just switch from the thing that's crummy into a better thing, and maybe you let it sit in cash for a month or two, but not much longer, right? You don't want to miss anything. So you're just trying to create real small gaps in the performance, and you do it by missing just a little bit of the downside. Don't have to miss that much, just a little bit. Just create that little 5 to 10% gap. Don't try to time the bottom. We'll get you as close as we can, but week to week, look at these articles that we update. And I just really can't recommend that you subscribe to Shooter's channel on the Investing 2020's website. I mean, his stuff is really good, and I think we're going to tighten up the format just to make it even better for you. And I will drop a couple more articles in here from time to time. All right, have a great day. Long term, the world is just going to be fine unless we blow it up, of course, or the aliens don't like us. But this bear market is just about over, and it's going to give us a really good opportunity to invest in that amazing future. All right, have a good rest of your day.